Good evening, viewers. Now I am taking this company accounts, panel accounts, panelization of accounts. Okay, when you go for sole trade concerns, you will prepare trading account, profit and loss account, and balance sheet. If it is a trading account, a trading business, when it is a manufacturing business, you have to prepare manufacturing account in order to know the cost of goods sold, and then you have to go for trading account in order to know the gross profit or gross loss amount, and after that we have to prepare the profit and loss account in order to know the net profit or net loss, and then you have to prepare the balance sheet. Okay, but when you go for companies, when you go for companies, you have to prepare the final accounts in two types: statement of income and statement of position. Statement of income includes the profit and loss account, and whereas statement of position it gives the balance sheet. When you go for statement of income, that is nothing but profit and loss account. You have to take into account the vertical form, because according to 2013 Companies Act, okay, the procedure of preparing the horizontal type of profit and loss account and balance sheet, it was completely abolished, and they prefer to take into account only the vertical form, that is in a vertical analysis. In a vertical manner they have to take into account all these things. There you will take into account the current year amounts as well as the base year amounts in order to find out the differences between the current year amounts as well as base year amounts. Here, first thing is revenue from operations. Revenue from operations includes the sales, sales minus sales returns. You will come across sales minus sales returns. That is nothing but revenue from operations. And after revenue from operations, you have to take into account the other incomes, that is whatever it may be, the other incomes that you receive, like interest received, discount received, like that. You have to take into account all these things. Okay, in the other income point, that is, you will come across in vertical form Roman letter 1, Roman letter 2, Roman letter 3, like that you will come across. Roman letter 1, it takes into account the revenue from operations, where you will come across sales as well as sales returns. That is, you have to deduct the sales returns and you have to show the net amount. In Roman letter 2, you have to take into account on the other incomes, that is whatever it may be, the other incomes that you receive, interest received or discount received or commission received, whatever it may be, you have to include in that. Then you have to total the first Roman letter 1 and Roman letter 2. That thing, it will give you Roman letter 3, that is nothing but total. And after that we have to go for expenditure. Expenditure includes various different topics. It eliminates different things. That is, first of all, it will take into account the expenditure that we come across on raw materials consumed. Raw materials consumed, how you will get opening stock of raw materials plus purchase of raw materials minus closing stock of raw materials. This will give you the raw materials consumed. Then changes in inventories. Changes in inventories means it will take into account the finished stock and work in progress, the opening balances as well as the closing balances. If opening balance is more than closing balances, then you have to add. If closing balances are more than opening balances, you have to deduct. So changes in inventories, that is the next step that we will come across in this revenue, I mean statement of income account. And after that we'll come across employee benefit expenses. Employee benefit expenses means we have to take into account the various salaries, wages outstanding, salaries outstanding, all these things we will take into account that thing. And outstanding amounts we have to add, and prepaid amounts if any, I'm mentioning that, mind it, prepaid salaries, prepaid wages, whatever it may be, they must be deducted, and outstanding amount they must be added. And the net amount only you have to show in the outer column. That is, you will come across particulars, notes, current year balances, and previous balances. In current year balances, the net amount must be shown. Then, after employee benefit expenses, you will come across financial cost. Financial cost means interest on debentures, interest on loans, everything we must show in this finance cost, and they must be added, and whatever it may be the outstandings you have to add, and whatever it may be the prepaid amounts you have to deduct, and the net amount only you have to show that in the outer column. And after that you will come across depreciation. So depreciation is very very important, because every company will have its fixed assets, and when we are going for company accounts, fixed assets, okay, we have to take, and we have to add whatever it may be the assets that we purchase. Here one thing you have to observe is that we must see the date. Whenever there is a date, then only the depreciation is to be charged. Suppose when there is no date, depreciation, there is no necessity for us to calculate depreciation on the additional amounts if date is not mentioned. If date is mentioned, you have to calculate the depreciation for how many months. Okay, because the financial year starts from 1st April and ends with the next 31st March of next year. So how many days and how many months we have to calculate, and we have to see the depreciation. And depreciation amount compulsory, it must be taken as an expenditure. Mind it, depreciation, it is not an addition to this thing, it is nothing but a chargeable expenditure. So chargeable expenditure, it should be treated as an expenditure, so you have to include that depreciation. And after that we have to go for other expenses. In other expenses, we have to include whatever it may be the expenses that are not taken in employee benefit expenses or financial costs and depreciation. Whatever it may be the other expenses that we come across, we have to take that, and we have to write, and we have to total that in the inner column, and the total amount, it should be shown in the outer column. So after adding all the expenditures, we have to take into account what is the total of revenue from operations. That is, taking into account revenue from operation, not only the revenue from operations, but also the other income, the total that we come across in Roman letter 3. We have to take, and we have to deduct that. So the net amount, whatever we come across, it is nothing but profit before tax and interest. If there is any interest that is to be given, you have to deduct that amount from the PBIT. That is, PBIT means profit before tax and interest. Okay, so from that you have to deduct the interest amount. Then you will come across PAT, profit, not PAT, PBT, that is profit before tax. And every company, they have to pay some tax to the government. So that tax, how much it is, we have to take into account, and we have to deduct that. We have to calculate, and we have to deduct that. Then after deducting, you will come across PAT, profit after tax, and that PAT, it should be transferred to the reserves and surpluses in the balance sheet. It should not be added to capital like how we are doing in sole trade businesses. In sole trade businesses, we are adding the net profit amount to the capital amount, and we are showing that. But it should not be done like that. It should be shown separately in reserves and surpluses. Whatever it may be the previous profit that was brought forward, we have to take that, and we have to add the current year profit, and we have to show that. So this is how you have to prepare the statement of income, that was derived by a company. And after that we have to go for statement of position. And these two things, statement of income and statement of position, it will be shown under third schedule, form number A and form number B. First, form number A will give you the balance sheet and form number B will give you the profit and loss account. Okay, this is the way that they will show. But while calculating and while preparing, you have to prepare first of all form B and then form A. Mind it, don't get yourself confused. Okay, form B must be prepared first and form A must be prepared next. This is the thing that you will come across. Okay, next, after preparation of statement of income, we have to go for statement of position. That is nothing but the balance sheet. Okay, in your in the BCom first year or second year, okay, they'll show balance sheet. That balance sheet is here nothing but statement of position. If you want to know that, you have to take into account that, okay, statement of position is nothing but financial position of a business or a company. It will give you the liabilities and assets. When liabilities and assets, when they are equal, the manufacturer or the businessman, he will be in a safe side position. Suppose if anything happens against to that, that is if liabilities are more than assets, he has to make some more, okay, borrowings, and he has to clear the liabilities. That is, the liabilities value, it increases. Suppose if you go for assets, if assets values are more than liabilities, then the businessman, he won't think that I can do anything, I can do anything because my assets position are more than my liabilities. So that thing and this thing is also very, very dangerous. So you have to see whether the liabilities total is equivalent to assets total or not. That thing you have to take into account. Okay, now when you are going for statement of position, okay, first of all you have to take into account the share capital and the shareholders funds. Shareholders funds includes the share capital and various reserves and liabilities whatever we come across. Okay, in share capital you will come across the 5 types of capitals, that is authorized capital, issued capital, subscribed capital, carried up capital and paid up capital. Here paid up capital will be given much importance than the other three types, that is authorized capital, issued capital and subscribed capital and called up capital. These 4 capitals just for namesake only we have to show, but the actual capital is nothing but the paid up capital. For that you have to add shares forfeited and you have to deduct the calls in arrears. Everything you have to do in the inner columns only, and whatever it may be the net amount you have to show in the outer column. And after that we will come across reserves and surpluses. In reserves and surpluses we will take into account all the reserves whatever the company people they are keeping, we have to show that. Okay, it may include reserve fund, general reserve, debenture redemption reserve, okay, capital redemption reserve, whatever it may be, share premium, whatever it may be, we have to take into account. And after that we have to take into account the profit and loss account balance in that reserves and surpluses only, and the total amount it should be shown on the outer column. Next, after that, shares application allotment money. This thing, it is a rare thing that we come across. It is a rare thing that we come across. Whenever it was given in the problem, we have to take into account that thing also. So we have to total that, and we have to total the total figure in the outer column. Then comes the non-current liabilities. In non-current liabilities, we will come across secured loans. Secured loans is nothing but the debentures that what we come across. If any interest is accrued, that is outstanding, we have to add to the debentures and we have to show that. And after that, we will come across, okay, unsecured loans. Whatever you have taken from the banks or from financial institutions, whatever it may be, you have to show that. That is borrowings. Okay, either the borrowings in India or outside India, you have to take into account all those things and we have to show that. And after that, we will come across current liabilities. Current liabilities it includes the outside liabilities, that is sundry creditors, bills payable, okay, bank overdraft, all these things they will come under this, okay, under this category. And those things also we have to take into account when we have to add. So thereby you will come across the amounts what we have to pay and what is the capital that was invested. This total you have to add. So you will get the liabilities total. And after that we have to go for fixed assets. Fixed assets includes, okay, tangible and intangible. Tangible assets means which we can see with our naked eye. So like buildings, plant and machinery, furniture, all these things we can see with our naked eye. We have to take those things. And some people they will say that, sir, we have to calculate depreciation and we have to deduct. Yes, we have to deduct the depreciation and the net amounts only you have to show that. Okay, you have to show that. And intangible assets. Intangible assets are those assets which we cannot see but we can feel. And those intangible assets, they will help us in carrying on the business. For example, if you take into account goodwill, goodwill is intangible assets. Similarly, patents, trademarks, all these things are intangible assets which we cannot see with our naked eye but we can feel, and they will help us in carrying on the business. All these intangible assets we have to take into account and we have to group them and we have to show them in the outer column. After that, whatever it may be the investments that we come across, non-current investments. Non-current investments is nothing but long-term investments that we come across. Okay, those things also we have to take into account. And after that we will come across current assets. In current assets you will come across trade receivables, okay, trade receivables, inventory, that is closing stock of materials, whether it may be raw materials, finished goods, or work in progress, whatever it may be, we have to take and we have to add them and we have to show them. And trade receivables, when you go for trade receivables, you have to take into account the sundry debtors and bills receivable. These two things, they will come under trade receivables. Whenever you come across any provisions, these provisions you have to take. Okay, you have to take. Sir, when we show them in statement of income, whether it is necessary, now when you are showing these provisions in the statement of income, there is no necessity for us to show that in this, okay, statement of position. And another thing is, you will come across in the trial balance as well as outside, that is adjustments. In that case, you have to observe one thing, whether the trial balance amount is more or the adjustments amount is more. When adjustments amount is more, the trial balance amount must be deducted and the difference must be shown. Okay, and whatever it may be the additional provisions, you must deduct that. That is, new provision only should be deducted. Okay, so like that you will come across cash equivalents, that is cash at bank. All these things you have to show and you have to total that. With that, the statement of position will be completed. Okay, like this you will come across. And one more thing here I want to tell you here, all is that whatever it may be the adjustment that you come across in preparing the final accounts of sole trader, the same type of adjustments you will come across. Along with those adjustments, we have to take into account some more adjustments like CDT, corporate dividend tax. And now corporate dividend tax, it was not taken into account, but previously it was taken into account. So whatever it may be the dividend declared by the company, from that you have to deduct 17% of the tax. that is 4% for cess, and remaining things is nothing for the tax on that dividend, because dividend is nothing but an income to the company people. Like that you have to take and you have to deduct that. Okay, so all these things you have to do, and then only you will come across the final accounts according to Companies Act of 2013. Mind it, according to the Companies Act of 2013 it will be like that. Okay, now with this the company final accounts will be prepared according to Companies Act of 2013. Okay, and the remaining adjustments whatever we come across, I'm going to tell you in the next video class. If you like this, please subscribe to my channel. And one thing I want to tell you here is, okay, I'm going to conduct online classes. Those people who are interested in taking the online classes, I'm giving my cell phone number 9849238902. So you can contact to this cell phone number and you can avail the online classes without any further thinking. Thank you very much.